Welcome to The Explainer. You know, every great business, every world-changing product, it all starts as just an idea. But to get from idea to reality, well, that takes capital. Today, we're going to break it all down, demystifying business finance and showing you exactly how those brilliant ideas get the cash they need to get off the ground and start growing.
All right, here's our game plan. We're going to start with why businesses even need money. Then we'll look at what kind of money they need, because it's not all the same. From there, we'll explore where to get it, from inside the business or from the outside world. And we'll wrap it all up by figuring out how to make the right choice.
So, let's start with the big question. Why is finance so dang important? Well, think of it like this. Without cash, a business can't do anything. It can't pay its people, can't buy supplies, can't even keep the lights on. It's the absolute fuel for the engine of any business, big or small.
And what's really interesting is that a business's need for money changes over its lifetime. First, you need that startup capital just to open the doors. Then, hopefully you're successful and you need money to expand. Along the way, you've got to replace old equipment, you have to invest in new tech to keep up, and all the while, you constantly need what's called working capital just to handle the day-to-day operations.
Okay, so we know why a business needs cash, but not all financial needs are created equal. You can really split them into two main types, and I love how this slide puts it. Are you funding a sprint or a marathon? Because your strategy for each is going to be totally different.
And here's what it boils down to. Are you paying this month's bills, or are you building next decade's factory? Short-term finance is for the everyday stuff, the operational costs that keep the lights on and the business running smoothly. Long-term finance, on the other hand, is for those huge, game-changing projects that shape the entire future of the company.
And that brings us to a super important idea, working capital. People call it the lifeblood of a business for a reason. See, it's the cash that covers all your costs in that gap between when you pay your suppliers and when your customers finally pay you. And this is no joke. Running out of this lifeblood is one of the top reasons new businesses fail. It's that critical. All right, so now that we know what we need and for how long, let's open up the financial toolbox. And first, we're going to look at the tools a business might already have sitting right there on the shelf. We're talking about internal sources of finance. And right away, this brings us to the first huge fork in the road for any entrepreneur. Do you fund your next big move with money you've already generated inside the company, or do you go out and find cash from the outside world like banks or investors? So if you're looking internally, you've basically got three main options. First, the classic, the owner's own savings. That's the personal skin in the game that starts so many businesses. Second, if you're up and running, you can use retained profit. That's the money left over after everyone's been paid. And third, you can have a little clear out and sell off assets you don't need anymore, like an old piece of machinery. Let's zoom in on retained profit for a sec, because it's a big one. The upside is huge. You don't owe anyone interest, and the owners keep full control of the company. But here's the catch. A brand new business has zero retained profits. And even for a company that's been around a while, the profits might just not be big enough to fund, a massive global expansion. So what happens when those internal sources just aren't going to cut it? Well, that's when it's time to call for backup. You got to look outside the business and open up the second half of our toolbox, the external sources of finance.
And the world of external finance is pretty massive. You've got the traditional stuff like bank loans and overdrafts. For companies with huge growth potential, there's venture capital, or issuing shares to the public. And of course, in the 21st century, you've got amazing new tools like crowdfunding.
A bank loan. It's probably the first thing that pops into your head, right? They can be pretty quick to get, and they give you a big chunk of cash to work with. But, and this is a big but, they come with some serious strings attached. You have to pay that money back with interest, even if your business is struggling. And here's the kicker. Banks often want collateral, which could mean putting your own house on the line.
Now, for those high-risk, high-reward businesses, venture capital can be a game changer. These are investors who are willing to bet big on risky ideas that could really take off. But it's a trade-off. In exchange for their money and their expertise, they take a piece of your company, a share of the ownership. You get the rocket fuel, but you have to give up a piece of the rocket. And just look at this number, over $1 billion raised through crowdfunding in a single year. This has become an unbelievably powerful tool. You're not just raising money from a ton of small investors, you're also proving your concept. If hundreds of people are willing to back your idea before it even exists, you probably have a winner on your hands.
Okay, we have laid out a whole menu of options. Internal, external, loans, investors. So with all this on the table, how on earth does a business pick the right one?
This is where strategy really kicks in, so let's walk through how that decision gets made. Making the right choice is really a balancing act. It all comes down to a few key factors. You have to think about why you need the money, exactly how much you need, and what kind of legal setup your business has. The time frame, the size of your company, and of course, the actual cost of the money are all part of the puzzle.
We can make this super practical. Let's boil it down to a simple 4-step guide. Step 1, match the timeline. Don't take out a 10-year loan to pay a 30-day bill. Step 2, figure out the amount. You're not going to try to sell shares on the stock market just to buy a new laptop. Step 3, know your business type. A solo freelancer has way different options than a giant corporation. And finally, Step 4, weigh the cost versus the control. Can you handle the interest payments, or is it more important to keep 100% ownership?
So when you strip it all away, here's the real takeaway. Choosing your financing isn't just about getting cash. It's one of the most important strategic choices a business will ever make. It shapes your future, it defines who you answer to, and it sets your path for growth. So the real question isn't just where to get the money, but what choice will build the future you actually want.